Welcome back. I am Josh Lewis, broker owner at Bywise Mortgage. With the mortgage and real estate update, we're going to stop calling it the coronavirus update because for the most part, those guidelines are behind us, or I should say the rapid changes and everyday turmoil of that is behind us. We'll have slow changes that come out. First, wanted to start off and talk about the elephant in the room. I've been absent from these updates for the last month, and a lot happened during that time. So I apologize for that. We lost my father about 3 weeks ago to a long battle with dementia. He was, in addition to being probably the best person I know, best person in the world, and not just regarded that by me, but just about everyone that knew him. But also my best friend. So that understandably, it kind of knocked the wind out of my sails, and it's been hard wrapping my mind around sitting here talking about numbers. But I know it's important. I know it's important to everyone. We talk in an age of income disparity, wealth disparity. The average homeowner has a net worth 40 times greater. It's actually more than 40 times greater than the average renter. The average renter, in fact, has a net worth of $5,000. I just learned the hard way that even when your plot is paid for, it costs more than $5,000 just to bury you. So for the typical renter, they don't leave enough money for their family to even take care of their final needs. So when I say that homeownership is important and essential, I absolutely believe that. And not only do homeowners have a 40 times greater net worth, 60% of that net worth is in home ownership or home equity. So buying a home, financing it properly, buying smart, buying wise, borrowing smart, and building wealth over the long haul is essential towards getting to the finish line and being able to care for yourself in retirement, leave a legacy and an asset for your family. So we'll get into a lot of that a little bit later. Scott, my business partner, and I, Scott Shang, are really going deep on building a lot of content of laying that out. Most of you watching this, a lot of you are real estate professionals. A lot of you are already homeowners, and you already understand that. You know the role that it plays in your net worth and your household wealth. We're really talking to the next generation, the millennials that are in their late 20s and their early 30s. They're just getting started in life and may or may not understand the importance of home ownership from a financial perspective. And one of my big pet peeves is we're in an era here where everyone wants to take home ownership down to just lowest common denominator, push button, get mortgage, contact this person, they'll write a contract for you and give you a rebate towards your closing costs. And we are entering a technological era where it's getting easier to do loans, and those savings do get passed along to borrowers. But for the most part, expertise has been taken out of the equation or devalued in the equation, and nothing can make a bigger impact over the long haul. So long way of saying a little bit of a rant here. We're 3 minutes in, and just want to talk about why I think this is important, why we do this, and hopefully why you're watching and listening and paying attention. There is a ton of content to go over. I'm not going to do that tonight. I just kind of wanted to get back in the saddle. Thursday night, we're going to try and go deeper on a number of the updates and guidelines and guidance that's come out in the last month. Talk about just home values and what's happening with home values, with home supply, home demand, and what that's doing to prices for those of you that are in the market. For tonight, we're going to talk about primarily refinances. That's what everyone is talking about, thinking of, looking at doing. There's over $11 trillion of outstanding mortgage debt in the United States, and probably 65-70% of that is refinance eligible with rates as low as they are. Unfortunately, with that, there's a lot of misinformation. Not necessarily misinformation, but just manipulation of the data, both for clicks in the media and in different ways from lenders. So I want to quickly go through this. The one that you guys are probably all seeing every Thursday, Freddie Mac releases their primary mortgage market survey. What that is all the loans they've bought the previous week. So when I say the previous week, that means this data is an aggregate of the prior week. Mortgage rates change daily and oftentimes intraday. And with that, we have out-of-date information by a week here. Now, the market, as we're going to see, we'll go back into the bond market chart, and you'll see that the market's been so flat that the week out of date has not been a problem here recently. But what's interesting is every week the media throws out headlines, mortgage rates hit an all-time low. So I wanted you to see what that looks like. We started way back here early in February. The 30-year fix, which is this blue line here, got us down to 3.5%. And you go, wow, 3.5% is an amazingly good interest rate. And it is, and it was. And that was over coronavirus concerns and how it was going to impact the rest of the world. At that point, at the beginning of February, no one had any idea how much it was going to impact us here in the US. As you can see, we kind of stayed level there for several weeks, went even lower, took a dip down to 3.25. And this is about when coronavirus became real for the United States. We had shutdown orders, all sorts of, I don't need to rehash it. You guys know what happened. And the immediate reaction is the mortgage markets just panicked and rates shot up. That really was about a week or two blip. And then we were back here right at that 3.25 level. And we go 3.25 just above it for week 1, week 2, week 3, right down to it. So again, here we have this one, we have a headline. Record, all-time record low mortgage rates. 2 weeks later, all-time record low mortgage rates. 3 weeks later, all-time record low mortgage rates. And then last week, a 3.15 average rate. So in addition to the data being 7 days out of date, Freddie Mac also quotes the average amount of points paid to get that rate. And usually you'll see them vary from 0.3 to 0.5, sometimes a tiny bit lower than 0.3, but almost always you're going to see 0.3 to 0.5. The interesting thing this last week, 3.15, the average was 0.8 points. So that I don't think that's a coincidence. We have one of the major wholesale lenders in the United States, United Wholesale Mortgage, about 2 weeks ago, it might have even been 3 weeks ago, jumped up and did basically a press blitz, PR release. Their CEO, Matt Ishbia, was actually on Good Morning America last week saying, hey, we're offering rates as low as 2.5%. Anyone who hasn't refinanced in the last 6 months should talk to a loan officer. And to a large degree, that's correct. The 2.5% rate is the silly part. They do offer it. They offer it on their rate sheet, and about 25 other lenders offer it on their rate sheet. And for every borrower that would be interested in it, it's 2.5 to 3.5 points. So you're trading a giant chunk of your equity for getting that super low interest rate. So the message is getting out there. Loan officers are picking up that message. Lenders are picking up that message and saying, hey, rates are at an all-time low. This might be the lowest they're ever going to get. Let's go and maybe pay some points and buy this rate down. So a couple things to know. We're going to get here a couple slides later and go into where our actual broker rates are today with 0 points. And you're going to see they're right above this level with 0 points, and with a point or 0.8 points being charged here a good bit lower than that. But I want to go through what we think is happening and why I think most people are better off not buying that rate down to an ultra low level, because there's a good chance they're going to go even lower. So jump in here, and this is the bond chart that we've been showing you guys all year. This goes back to March. Some of the chaos here is getting eradicated in another 2-3 weeks. We'll have an amazingly flat bond chart. So the thing to remember here, this reflects bond prices as they go up. That's good. That means interest rates are going lower. So with that, this was a good sign of rates going better. Now, we've had massive Fed intervention here of buying mortgage bonds, and they've been trying to keep them and trying successfully to keep bonds in this range here for now going back to the middle of March, end of March. So all of April, all of May, we've got 60 days of going almost nowhere from, at the high of 104 and a low of 103. But what I wanted to show here is we're going to have a little bit of a breakout. Before I go to that next slide, this line here is the 25-day moving average. And once we fell below that, that was resistance, meaning the bond prices don't want to go above that. And then we have this 50-day moving average. And every time we've gone down to it, that's held, and that's been our support. So what this does is this forms a pennant formation. Now with my pretty drawing here, hopefully you can see why they call it that. We have lower highs and higher lows, and it's essentially a coiling. There's a bunch of energy in the market, and that will usually lead to a breakout. And the majority of the time, the breakout is to the direction of the previous trend, which was for higher bond prices. So we are expecting the bond prices to continue to go to the high side and rates to get better. That is not why I necessarily expect rates to be better, or why I don't think people should be paying points. What we've talked about a month or so back, and I actually, you can tell I'm a little bit of a space cadet right now. I wanted to throw that slide in there of showing what the historical spread is between the 10-year Treasury and 30-year fixed rate mortgages. For the last 10 years, it's averaged 1.7%. The 10-year Treasury right now has been bouncing around between 0.65 and 0.7%. So Treasuries have gone really, really low. Mortgage bonds have done really good and gone high, meaning yields are low. Mortgage rates to consumers are high. As crazy as that sounds, we're looking at all-time low as the headline, are high relative to where they should be. If we had our historical average for the last 10 years of a 1.7 premium on top of the 10-year at 0.65, 30-year fixed rate should be at 2.35%. That tells us, other things being equal, if the economy stays at this level and the mortgage, the 10-year Treasury stays in that 0.65, 0.7 range, and we normalize back down to 1.7, rates are going to go much lower. But we have a lot of room for them to even get higher. I personally think the 10-year is going to be that low, and I know some really, really smart people, a lot smarter than me, that think that it's going to go as low as 0.3%. But when we see that, we're going to see mortgages likely over the next 12 to 24 months go even lower than they are right now. So the best example I went through with a client, longtime client, has done a bunch of loans with us. He's getting all of the flyers in his inbox. He's seeing banner ads on the internet. He's seeing commercials of saying, hey, I can get a 2.75% 30-year fixed. I said, absolutely, you can. But the numbers that we're running, and it may make sense for him to pay the point, the numbers we were running, that with the point, he could get 2.875. With a no-cost loan, he was at about 3.25. And we start looking at that. The break even is out about 36 months. There's nothing wrong with a 36-month break even, or even a 48-month break even. There's a good chance that someone will stay in that loan and it locks in the current low interest rate. But it's important that you don't just take what's sold and pushed on you. I think we're going to get those lower interest rates for free. Again, it may take 12, 24 months. We need that forbearance premium taken out of interest rates. And when I say forbearance premium, the forbearance issue is getting a lot clearer, but lenders are still scared. They don't know how many of those are going to not be able to repay, that might end up in foreclosures or short sales. I don't think it's going to be a huge issue, but lenders are still concerned and worried. And so we have that big premium. We're at over 2.5% spread. When you say we're at 3.15 versus a 0.65, we're right about 2.5% spread. That should normalize to 2% or lower, and Treasury should stay low. So bottom line, the most important thing to understand and hear from all of these folks is that nearly everyone with a mortgage is in the market for a refinance right now. Definitely talk to an expert, talk to an advisor, talk to more than one. There's nothing wrong with getting quotes and making sure you're looking at something competitive. The biggest mistake I see is someone calls the crazy commercial or sees a billboard and sees a number and calls and takes whatever the 22-year-old kid in the call center sells them, versus having an expert walk them through what each of those options means. Any of them can be the right one for you, but it's important that you be educated so that you can make an educated decision. So with that, let me close with where our rates are at right now. The standard balance loans, the high balance stuff is still out of whack. Good, very good interest rates, but they're out of whack relative to where they have been historically. So we look at loans under 510,400, conventional rates 3.25 with 0 points with very low fees, under $2,000. Most of them are about $1,500 to $2,000, 0 points. If we want to pay a point on that, it's going to be under 3% for most borrowers, about 2.875. The FHA is about 2.75 with 0 points. VA also at 2.75 with 0 points. Also have seen some crazy things. People call and tell me, hey, someone told me I can get 2.25 on on my VA loan or on my FHA loan? You absolutely can. But again, it's taken a couple points to do that. It's primarily being done to veterans on these VA loans because the VA will allow you to finance those points. So again, you get a salesperson in a call center saying, hey, I can get you 2.25. You'll have the lowest rate in the world. Can you believe that? And they don't explain what it means to actually pay those points to trade your equity for that low interest rate when there's a real good chance we're going to get that for free in the future. So the high balance stuff, as you can see, is a little bit higher. Instead of 3.25 with 0 points, you're about 3.5 with a half point. FHA 3.25 with a quarter point, and the VA 3.25 with about a full point. The VAs are the worst right now, and the primary reason is just because they're having the highest uptake rates on the forbearance. So again, it may take a month or two, but those should normalize and end up being only about an eighth above the standard balance loans. That's where we typically are. It's about 0.125 higher in rate, and you can see right now we're a quarter to a half with some amount of points being involved in there. And for the most part, with the FHA and VA, we can't even do a no point option, or the rate is so high that you'll choose to pay those points. So said I was going to be short and brief tonight. I'm running here at 15 minutes, so I will get out of your hair. If you tuned in, I appreciate it. Appreciate you for paying attention. All of you, Christine, Rhonda, Bridget, all of you who sent your thoughts our way, I really do appreciate it. You know, it's the nature of life. None of us last forever, but it's not fun when it ends. So my only hope, and the thing that I'm taking and learning from it, is to be as good to as many people as possible, that people will say the good things about me when I'm gone that they did about my dad and do about my dad. So again, thanks for joining us. We'll be back Thursday. We'll go much more in depth, and we'll have less about me and more on the mortgage markets. Howard, here, actually, let's jump in. We'll answer a question real quick. Howard says, can you explain a point example based on 500,000? A point is 1% of your loan amount. So a $500,000 loan here, conventional loan, 3.25 at 0 points, you'd have on a refinance about $2,000 of total costs. If we wanted to get that 2.875% rate, you would pay 1 point, or about 1% of the loan amount, exactly 1% of the loan amount, $5,000. So instead of having $1,500, $1,800, $2,000 of closing costs, you're going to have $7,000 of closing costs. So as a homeowner, you're essentially trading equity for a lower payment, and there will be a break-even period over time. But again, if we believe that there's a better than 50-50 chance of rates moving lower in the future, what we're doing for all of our clients now is looking at low and no cost refinances to lock in the benefit of the current interest rates, but still leave us in a position where we don't have the sunk cost of having paid points, and can take advantage if and when rates do move lower in the future. So again, I appreciate all your thoughts. Any of you have questions like Howard, shoot them out, leave them in the comments. We're going to cover a lot of stuff Thursday, and I know there's so much craziness going on in the market, that there's just a lot of questions. Homeowners, real estate professionals, whatever you want to know, let me know, and we'll go through it here. All right. Have a great night, and we'll talk to you guys Thursday.